But we set something up today that will live way longer than us, that will outlive us into perpetuity. If you set it up correctly from the start, you really can't screw it up. The whole life, the product is never going to do anything. You need the process if you want to get wealthy. We have to start teaching our kids how to be in control of their money. We have to start teaching our kids how money works, and we have to start teaching our kids how to be the bank. No matter where you're at financially, you're in the exact right place to get started. Welcome back, everybody. Another wealth webinar, which means it's another Wednesday, and I'm really pumped because this is the first Wednesday that we are testing out the new studio. So some of you saw the video or saw the photos I put up of this, and our studio is about 95% completed. So really pumped to be doing the first webinar right here from that. And, you know, I was thinking about what to talk about today. We got a bunch of new people. We got a bunch of people that have been here for a long time. Who's been here for a long time? Put I in the chat or put OG in the chat. There's Tess. So we got a bunch of OGs on here. Well, we just finished up an event out in I almost said Las Vegas because we've been there too, but out in Utah, and we had a whole bunch of OGs, but we also had a whole bunch of people who had never met us, never seen us, and never knew anything we did, that literally came just because they wanted to see what it was about, and they never left, and literally we had to kick them out at the end. So sometimes getting around the campfire, just know it could be a late night, and that was a late night. But what we're going to talk about today, okay, I want to talk a lot about legacy, but I want to talk a little differently about legacy, and I want to show all of you how you can create something for your family, but more specifically for your kids and then their kids, so your grandkids. I want to show you, I guess many of you know it as the Rockefeller family banking system. I might not nail it exactly how the Rockefellers are set up. They've got significantly more money than I do, but I just want to show you how you can set something up that will perpetuate your family's legacy, not just your family, but also future families you will never, ever know. How many of you have ever thought about that? How many of you ever thought about setting something up during your life that will literally perpetuate and fulfill your family's future generational wealth? And there's nothing that needs to happen other than following a couple simple steps. Has anyone ever thought about that? So the reason I decided to hit this topic is there's always a story behind it. I was on the phone with one of my best clients the other day, and we're just talking and we're going back and forth about their policies, and they put millions of dollars into their policies each year. They're in the development space. And we got talking about our kids. You know, he's like, hey, how's Vivi doing? And I said, how are your kids doing? And we got talking about it. He says, so, hey, you got this trust system set up. Like, talk to me a little bit about what that's doing for your daughter and why you're doing it. So today, I thought we would just dive down that path. And I want to explain to each and every single one of you that although my trust setup probably would work for maybe only 1% of you, we're not going to talk about my trust setup. All we're going to talk about is a setup that will take care of future generations. And we're going to talk more about the why, not the what, because the what can be different for everybody. Like, what kind of trust do I need? I get that question all the time. I have no idea what kind of trust you need. Maybe you need a revocable trust. Maybe you need a revocable and irrevocable trust. Maybe you need an ILIT. So you can all see, like, I'm going right over some people's heads. Who cares? Can we all just agree that every single one of you in a roundabout way can just, here, I'm going to do this in black, can kind of understand the basics that there are different types of trust, but let's just call it a trust, just to keep it simple. Okay, so here's one of the fundamental things that I want you to understand about a trust that would be important for each of you. A trust will give you a set of instructions when you're gone. In other words, all of us, every single one of us, will graduate someday. Some sooner than others, some later than others, but we will all graduate someday. And when I mean graduate, I don't mean from high school or college. I mean the big graduation where we get to go to heaven. So when that graduation day happens, something else is going to happen. Your assets are going to pass on to somebody. Notice how I didn't say to your family, I said to somebody, because some of you will fail to do any planning, and you know who will control your assets? a bunch of attorneys you've never met, attorneys in some cases that are appointed by the state you live in. I live in New York, and believe me, you don't want attorneys appointed to handle your probate in your estate. Like, you just don't want to deal with that. So why don't we just eliminate all that? So let me just write down, a trust allows you to bypass probate. Okay, from the simplest point of it. Now, there's a lot of other things that bypass probate, like over here. I'm just going to write it because we're going to need this. Life insurance, death benefit, bypasses probate. So if you die and you've got one of those specially designed and engineered whole life policies we talk about, the one thing that I can tell you is the life insurance death benefit will pass directly on to your beneficiaries or your family, and there will be no probate, which means no attorneys, no nonsense. It goes directly to who you want it to go to. However, one thing, not all of you, but some of you will have to deal with, is estate taxes. So I'm going to write this up here. So what are we trying to do? We're trying to bypass probate, but we're also trying to bypass more taxes. Okay, so I'm just going to put, we want to bypass paying taxes. But you see, some of you would say, I don't care about taxes, I'm dead. Right? You are dead. You're gone. So you don't have to pay any more taxes, but your kids might, your significant other might, your spouse might. Somebody's going to have to pay the taxes and estate taxes. So I'm going to get specific and write estate taxes. And the limits, you know, I'm not going to get into the limits, because even if I told you the limits today, there's a good chance that when they sunset, which is in, I think, next year, if I'm not mistaken. Do we have any CPAs on here? Because you folks would have all the dollar amounts. If anyone knows the estate tax limits right now, put them up in the chat. I just don't have the exact amount. And also, if you know when they sunset, because, and everybody knows what a sunset is, right? The sun goes down. Well, different laws that are passed in and different things that happen out there, they all sunset, and then somebody has to decide, are we going to continue this on? Are we going to let this go? So that's what we need to know. Yeah, I know if Jimmy's on here, he would know. So I'm kind of just calling Jimmy out. And if we got Jimmy or any other CPA on here, we can kind of get a little bit more info on the estate taxes. But you know the fun thing about estate taxes? Depending on the state you live in, you're going to pay federal estate taxes, okay, which can be as much as 40% of your estate. Now, that's if you're over the estate tax limit. So let me, I think here, because we don't have a CPA on here, it's somewhere around $14 million. And again, you guys can Google that and look it up, or talk to, you know, your CPA or your attorney to get that amount. But let's just call it 14 million. Somebody just put it up there. There we go. So I wasn't, there's Jimmy. What's up, buddy? 2014, the first 13,610,000. So look at that, man. I was pretty darn close. Even Jimmy would say, Chris, you're in the ball game. 13,610. So 13,610, and that's million. So I'm just going to write an M after that. Of an estate is exempt. So if your estate is worth less than 13,610,000, it's exempt. Woo! Some of you are like, oh, thank God, I'm not going to have to pay that. Well, hold on a second. If that sunsets and reverts back to the old estate tax limits, it's significantly less. I don't remember, but I do remember being a financial advisor when estate tax limits, I think they were around 5 million. Man, that was a bigger problem, because I bet you if I ask this audience, how many of you, when you die, think your estate, everything you own, will be worth more than 13,610,000? Put I in the chat. Now, how many of you, when you're gone, when you die, so that could be way into the future, how many of you think your estate will be worth more than $5 million? I bet you every single person on here will say that their estate's going to be worth more than 5. And I hope, because I know this audience, I hope all of you say it's going to absolutely be more than 13 million. Because if you're telling me your estate's not going to be worth over 13 million, you're not thinking big enough. You're not. Because you're here today. I don't care what your estate looks like. I don't care if your estate's negative right now. You got 5, 10, 15, 20 years until the day you graduate. Maybe you got 30, 40, 50 years till that day. You are going to have an estate tax problem. Can we all agree? Because that's a good problem. That means you got lots of money. But when we've got that, we also do not want to give that to the government. Now, Jimmy, correct me if I'm wrong here, because I don't want to pretend I'm the CPA, because I can't give you tax or legal advice. But let's just say it's 13,610, and there's a little bit more to it. So let me just read what Jimmy said. In 2024, the first 13,610,000 of an estate is exempt from taxes, up to $12,920,000 in 2023. Estate taxes are based off the size of this estate. So there you go. So let me just see. I want to check the room here real quick. Per person, correct. Or is that's per family, I believe. Jimmy, is that per person, per family? How did that work? See, there we go. Gina's like, shit, I'm going for $1 billion. So Gina's going to have a big problem because if you go past this estate, the Fed is going to take about 40% of that. So right there, if you've worked your whole life to make your estate over $14 million, the Fed, anything over that is going to sit there and they're going to basically sit down at your table, and you have just now, or your family's table, and your family has now just inherited a new partner, an unwanted partner, a very crooked partner. They don't want that partner there, but you allowed the partner to sit there if you didn't plan to not have that partner enter your family's life when you're gone. So we don't want to give the Fed 40% or the IRS. And then there's also state estate taxes. So we're not going to even get into that. So I think all of you will agree that you'd like to bypass that, right? You'd like to just get rid of that. So the one bad thing I got to tell you is that the death benefit that comes off those life insurance policies that pays direct to your beneficiary, your kids, your family, your spouse, whoever, that death benefit counts toward your estate. Isn't that crazy? Now, the death benefit is tax-free, but it still counts toward the estate. So with everything you guys do and to build up your estate, and that's all the cars you have, the houses you have, the rental you have, the 401k, all that stuff that you build up in your lifetime, plus the death benefits. And if any of you are doing the infinite banking concept, which is what we teach, being private bankers, that's not going to help your family because the death benefit paid direct to your beneficiary, which is your kids, is counted towards your estate. So here's the first thing I would tell all of you to possibly consider. And I'm not telling all of you to do this. I'm saying possibly consider this. Instead of having your death benefit paid directly to your beneficiaries, have it paid directly to a trust. And what you could also do, and this could get kind of cool, you could have your life insurance owned by the trust. So let's just see if we just put beneficiary, okay, being the trust. Now, when you die, the death benefit, okay, we'll just write death benefit is paid directly into the trust. But to really make this all work, one other thing has to be changed, and that is the ownership. So if you don't change the ownership of the life insurance to the trust, you may not avoid estate taxes. So all of that is really simple. Any attorney that you get with can help you with this. We have attorneys that we can refer you to that are experts in this, and they can help structure yours. I'm not here to help get you set up with a trust. I'm here to help you understand what happens after you get this stuff set up. And when you understand that, you're going to understand what today's all about. I just had to bring you up to this point that it's pretty simple. We got to bypass probate, which you're going to do by just having a death benefit payout. So here, let's talk about some of the probatable assets. Now, there's lots of them, but let's just hit the main ones, and I bet you a lot of you have these. Who on here has a checking account? Have a savings account? A CD? A money market? A brokerage account? Any of you got any of those? Got a car on the driveway? Probatable, probatable, probatable. Okay, all those assets don't just pass to your beneficiaries. So that's another thing to consider. So you want to try to keep as little money in those assets that could, have a problem with probate. You want to try to keep as little money in those. But most people don't. They put the most amount of money in those. Why would that be? Well, that's what they're told to do. They're told to put the most amount of money in the places where, all the money can be or when you pass, can have to go through probate. You see, it's all interconnected and you can figure the rest out. So we're just trying to avoid all these. So now I'm just going to clean this board up a little bit. We're going to get rid of the probate. You all understand that. You understand the estate taxes. So now we understand that we can change our life insurance to basically be owned and also be the beneficiary of the trust. But let's talk about the whys. Okay, this is where the rubber meets the road, and this is where my conversation with my client came in. Why would you want to do this? Why would you want to have to file another tax return for a trust? Why would you want the complexities of one or multiple trusts? Well, I already said it, and I'll say it again. An instruction manual when you're gone. So if any of you ever looked at the Rockefellers and the Vanderbilts, and we just did a video on this not long ago, the difference between the Vanderbilts, which actually back in their day, everybody I think knows this, but back in the day, the Vanderbilts had more money than the Rockefellers did. You all know that to be true, right? The Vanderbilts were wealthier than the Rockefellers. But the Vanderbilts didn't think past their current generation. So when the Vanderbilt, and I don't remember their names, but you can look it up, but the Vanderbilt died, the first one, it passed on to his son. His son did a really good job and actually built the Vanderbilt estate, the whole, all their wealth was built up even more. But then, if I'm not mistaken, the second Vanderbilt, the son, passed away in his 50s. That money went to who? Does anyone know? Who did that money go to when, I should have studied their names, and actually here, I'll just pull it up here real quick. Again, today isn't to talk about names or what they did, but the Vanderbilts, after that second generation, it passed on to the third generation. And the third generation was so entitled, so used to this lavish lifestyle, these fancy things. They owned and bought the craziest stuff. And all of you know the rest of the story. They literally spent the entire family fortune. So they were no longer the wealthiest families. They still had the reputation, they still had the credibility, but they weren't wealthy anymore. Now, what happened when the Rockefellers passed away? Well, you all know. The Rockefellers passed away. One thing that they had is they had built a family banking system. Okay, so I'm just going to write family banking. And the Rockefellers were heavily involved in banking. They were involved in lots of things. We know them as oil, but they were also into family banking. So what did family banking consist of? Well, family banking consisted of life insurance policies, believe it or not, whole life insurance policies. So their family banking system didn't really reside at the banks. It resided with a whole bunch of whole life policies. And the Rockefellers set up a system so that every child that was born, the trust, okay, the Rockefeller Trust, so let's just write I don't know where B came from, but the Rockefeller Trust funded the purchase of a whole life on every child that was born. And the trust owned those. And can you all guess who the beneficiary of those policies was? Anyone? Yes, I know Big Pharma was originated by the Rockefellers. Totally know that. Not saying the Rockefellers were all good, okay? I'm just telling you, this is something that they got right that we can learn from, okay? I don't think any of us want to start a pharma company today. But so right here, all these policies were opened up on children that were born into the Rockefeller Family Trust. The trust, or the series of trusts, again, I'm not getting specific, owned all of these beneficiary or all of these whole life policies, but the trust was also the recipient in terms of beneficiary. So if one Rockefeller happened to pass away, the death benefit from that policy would be paid into the trust. Okay, everybody understands that. Pretty simple, right? When somebody graduates, that death benefit is paid somewhere. The Vanderbilts probably had it set up so that it benefited the next children, right? The son and then the grandkids that ended up squandering all the wealth away. That would be how they did it. Now, the Rockefellers didn't allow that to happen. They didn't want all their hard work to go away the day that one of them passed away and went on to the next generation, because they saw we have a lot of wealth and we're going to build more wealth because our businesses are going to keep doing well. And eventually, I would have to believe our children will start getting entitled, start getting used to this, because once a luxury, now a necessity. So things that were luxuries for one generation now are necessities for the next, which means they cost more. So they knew this. So how they did it is they set the family banking system up, and it goes by a lot of names. We call it private banking systems, but it was their family banking system, and it was fully funded by whole life. So during their lifetimes, they had lots of businesses. So let's just write over here, business 1, business 2, business 3. And folks, I am keeping this incredibly simple. So some of you already know more, and I see it in the comments. You're like trying to tell me the whole story. I'm trying to keep this 5th grade level. We can dive deeper in another video, but today I just wanted to hit the surface, and I wanted to really show you how you can do the same thing. And there's a lot more to it once you decide to do that. So all these businesses, guess what a business needs to operate? They need money, right? Where does the money come from for your business? Who can tell me when your business needs money, or a future business that you're going to open, where are you going to get money for your business from? Who can tell me? Paul, some of you are already down the rabbit hole, but yes, the bank, right, Gina? Most people would go to a bank and they would try to take a loan from the bank. Has anyone tried doing that recently? Anyone tried doing that? Try going to a bank to get a loan for a brand new business, even if it's the greatest business idea ever? Has anyone tried doing that recently? How'd that work out? So I'm going to try not to butcher the name, but Rigo, is that how you say it? But Rigo, how did it work going to the bank to try to get a loan for your business? Was it super easy right now? Okay, I did get the name right. Was it easy? Because I'm hearing from a lot of people it's not easy. Matter of fact, me getting a loan, okay, and I'm pretty damn good on paper. I'm over a 800 credit score, got plenty of assets, really good income. So like, oh, I check all the boxes. It's hard for me to get a loan. I mean, I'm not going for a loan, but I'm just saying if I go for a loan for something like we just closed on a property today that we actually did use some bank money, okay, because we didn't have enough that we could fund the entire purchase of it because I got my money out working for me. Many of you probably have loans that I'm lending money to. So banks are tough. So what did you say? I had $100,000 in the bank, decent credit score, and still no go. So right there, Rigo, take it away from me. He had a hard time getting a bank loan. Well, do you think maybe the Rockefellers would have a hard time getting a bank loan no matter what they looked like on paper? Absolutely. But do you think they have a hard time getting a bank loan from their private bank? So in other words, let's just kind of go one step further. Let's just say that all these policies have, I don't know, let's keep the math simple. Let's say all these policies way back in the day had $1 million in cash value. And that $1 million in cash value meant that they had $10 million in death benefit. Okay. So we'll just talk about one of the policies. And folks, you know, I know millions for some of you seems like a lot. Subtract a 0, 2 zeros, 3 zeros, whatever number makes you happy. I'm just keeping round math. Okay. So let's just say business number 1 needs $50,000. Business number 2 needs a loan for $100,000 for the purchase of some equipment. And business number 3 needs a loan of $500,000. They're going to strike a new oil well or something, right? So where are they going to get this money if these are brand new business ventures? They just started them. They need to be capitalized. And the bank might not give them a loan. So they go to their banking system, which guess where their banking system is controlled by? A trust. Okay. The trust. And the trust has trustees. And there might be several people, and there's people that will vote on this. And there's a whole system you can put in place, as advanced or as simple as you want. But somebody gets to decide how the assets of the trust are actually distributed. So if business number 1 puts together a loan proposal for $50,000, sends it to the trustees of the Rockefeller Trust, do you think the Rockefeller Trust, if the business seems legitimate and seems like a good plan, do you think the Rockefeller Trust is going to say no to their own family? No. The Rockefeller Trust issues a loan. Okay, so let me just get rid of family banking up here. I'm just making room. So the Rockefeller Trust issues a loan for $50,000 to the family member for that business. And how much interest are they going to charge? Who can tell me how much interest they're going to charge? Anything they want. Because when you own the bank, you set the rules. So they could charge any interest they want. And since this is a brand new business, the family trust knows that the cost of those funds is 5%. We'll bring it to today. It was probably a lot less then, but let's just say the cost of funds is 5%. That's the amount the insurance company is going to charge them. So they lend this $50,000 out at 7%. Okay, a 2% spread. Because the family trust, the banking system, okay, has to be profitable. So they lend it out at 7%. So the trust makes a 2% spread. Everybody catch that, right? This is just like a bank, right? If you go to Key Bank, Bank of America, any bank, and you go to take a loan, and they, like today, that loan that I closed on for that ski chalet that we just bought, 7.98%. How much does that bank pay me on my savings account? They make a spread. That's how banks work. The bank I went to, 7.98% was the amount they charged me. You know how much they pay me on my savings there? Less than 1%. That's a pretty good spread, right? So this bank is doing a much better job for their family members, are they not? But the other thing you must understand, and this is what the Rockefellers understand, is because these are whole life policies structured a specific way, that $1 million. So we took $50,000 from the family banking system, which where did that money come from? Does anyone know? It did not come from their $1 million that they had in cash value. It came from their death benefits. So what the insurance company does from their general account, they issue a loan for $50,000 and they subtract $50,000 from that $10 million death benefit. Then what they do is they come over here to the cash value and they put collateral on that $1 million of 50,000. So they technically take away access to 50,000 of the $1 million because that loan was just made. But you see, the banking system, the trust, and all the cash value in these whole life policies is $1 million. So $1 million minus 50 is not the amount they're earning interest on. They're earning interest and dividends on $1 million. So now are they only making 2%? I kind of tricked all of you. Remember the 7 that they're charging on the loan and the 5 that they're paying the insurance company? That's 2%. That was the spread. They're not just making 2%, folks. They're making 2% plus the interest and dividends, which the interest and dividends, if I just go to today's standards, are about 5.2 to 6%. So they're making, let's just go right in the middle. We'll go 5.5. Fair enough? Yeah, that's pretty fair. They're making 5.5% gross on the $1 million plus the 2% spread. How many of those loans do you want to do if you own a family banking system like this? Well, you definitely want to lend here, but because this business number 2 is for equipment, you might charge 10%. So maybe this loan is 10. This one was only a 7% loan. This one's a 10% loan, and that 10% interest is paid back to the trust. This 500,000, maybe it's a really low risk, so maybe they only charge 5.5. They make a spread of 0.5%, but that money goes back here. So you see, during your lifetime or during the Rockefellers' lifetime, they had access to capital within their own system. They didn't have to rely on the bank. Now, I'm sure they still used banks, but the majority of the financing they used for all their oil explorations, everything they did in all their businesses, including, you know, the crappy businesses they did like pharma, which back then, pharma was heavily utilizing oil. Oil today, and I don't know that to be a fact, is heavily used by the pharma industry. Well, I mean, if you owned an oil company, wouldn't you want to find really unique places where oil is needed to make a product that is sold in mass quantities? Pharmaceutical. So I'm not saying it's good, bad, or indifferent. I'm just simply saying back then, it was a means to make their business bigger. So now they got all these businesses, and all these businesses are making more money, okay? And they're all paying loans back to the family trust. So as these businesses make money, what do you think the businesses do? Well, the businesses start policies as well. So the businesses do COLI policies, and these policies are owned by the businesses, which then make sure that if somebody dies, everything can be utilized by the business. But everything for the businesses all ties back to the trust. Because eventually when you get a business to a certain size, you personally want to you want to control it, but you don't want to be the person owning it, right? Does that make sense? You want to more control it, and you don't so much care about all the ownership stuff. You just want to control it, because if you control it, that's the flow of money. So I don't know that to be true, but I'm just assuming that that's how that works. So you understand all that. Does anyone not understand that? It's pretty simple stuff, isn't it? Everybody understands a family banking system looks just like a regular banking system, but all the money, no money leaves this family. No money left the Rockefeller family. Every loan that was issued from the Rockefeller Family Trust, which was funded by the cash flow of these whole life policies, and then all the money from those loans coming back in, what do you think happens to the family trust? What is the only thing that can happen? It gets wealthier. It gets wealthier and wealthier and wealthier. But hold on, now it gets even better. So forget about all these businesses, because we all understand this. Forget about how they utilize the money in the loans, so we don't need to do this, because you all understand all this. What else is another thing that's going to happen here in this equation? Some folks are going to die, right? Some family members are going to die. So remember, I said all the death benefit alone is $10 million minus the loans. How much did we do? We did 650,000. So now we got 10 million minus 650,000. Let's just round that up to keep this simple to $1 million. Let's just say all the loans that were done were $1 million. And one of these policies, one of the people dies. So this Rockefeller passes away, has an explosion at the oil field. Okay, this Rockefeller is no longer. And this Rockefeller had a death benefit of $2 million, but they were using 500,000 of the death benefit. Okay, so now how much is left? $1.5 million. They're gone, which means that policy is now no longer feeding the cash value. But what happens? $1.5 million just came into the family trust. I want you to all understand that. This policy had a death benefit of $2 million, but the cash value was probably only $200,000 in this. So would you rather have $200,000 as a family, or would you rather have 1.5 million? Let me ask that again. Would you rather have 1.5 million or $200,000? Which one would be better? All right. I think every single one of you would say the 1.5 million, which is the death benefit. Remember, this is the death benefit. This is the cash value. We got to use the cash value. That particular family member in the family trust got to use that cash value the whole time they were alive. But now they're not alive anymore. So now the cash value, it doesn't go away. Okay. It just fed into the death benefit. So now the cash value is a non-issue because they're gone. But the death benefit then comes over here. So before they had $1 million in total cash value they were using, of which 200,000 of it was here. But now $1.5 million comes into the family trust. How much cash value does the family have to use now? Well, it's no longer $1 million. Now it's $2.5 million. 2.5 million. They went from $1 million to $2.5 million overnight. Now I know they lost a family member. And I know there's burial costs and funerals and all that grieving and everything else, but I'm just talking mathematics and money, okay? Let's take the human element and the emotional side out. The family banking system just got an influx of $1.5 million. Now, can we just keep doing that? You know, another one dies, another one dies, another one dies. All of a sudden, at the end of the day, we started with $1 million, okay? That's what we started with. One died, we had 2.5, but now they all die. And now we're on to the next. Now, when they all die, that doesn't mean that they didn't have kids. So now this was the original family, but then this original family also had kids. So all the kids have, and sometimes they had multiple kids. Like this one popped out 6 kids. I'm just joking, but each one of those kids is required by the trust, by the family banking system to have a whole life on them. And who pays for it? The family banking system. But really, let me ask you, who's paying for the premium deposits on future generation policies? If I want to see how much everybody's paying attention, who's really paying for all those future premiums? Okay, I like what you're saying, Gina, but it's the trust is the person writing the check, but where did all the money over time come from in the trust? The insurance company, Jimmy. Jimmy said the insurance company, right? Remember what I just said. That first generation, unlike the Vanderbilts where they just squandered the money and just spent it, this generation controlled their wealth inside of a trust, made loans to their family. Their family never ever had to go looking for money, never ever had to be told no unless it was like, hey, I need a loan for like $50,000. I'm going to go buy some crack. You cool with that? The family trust isn't going to fund their crack habit. Okay. They're going to fund business operations and cars and houses. The family trust probably owns all the houses for here. But where are the mortgage payments made? Because just because the family trust owns the house doesn't mean the family member doesn't have to pay a mortgage. They have to pay a mortgage, but the mortgage goes back to the trust, the family banking system. But now, when they all passed away, we now went from $1 million to start at the beginning of that family cycle. Now all those family members die. Let's call it, I don't know, let's call it a 70-year time frame. All those original family members are now gone. The trust is now $10 million, not even assuming any loan interest, any of the payments. So it's probably significantly more. I'm just keeping this simple. So now it's got $10 million. So who's funding all of these future policies? Jimmy's right. The life insurance company that these policies are with, really at the end of the day, funded all those future generations. And hold on, as we go further and further and further down, like, right, the first generation is gone. Let's use me. I'm gone. The death benefits all passed to my trust. The trust then feeds Vivi and Vivi's, business stuff that she does, and Vivi's school, and Vivi's everything that she does is all funded. And then Vivi does what? Has kids. And then when Vivi gets older, her kids have kids. But eventually, people pass away. It's one of the guaranteed things. It's a beautiful word, right? Guaranteed. What are you guaranteed in life? Death and taxes. I'm trying to show you how to avoid paying unnecessary estate taxes. I'm showing you how to avoid dealing with probate and attorneys that aren't on your side all the time and drags things out. And I'm also showing you how to get paid with tax-free dollars. Now, I know you got to die to get those tax-free dollars, but you really didn't have to die because you had $1 million to start of tax-free cash value that you could loan out and use. But it just keeps it perpetuates. You see, at the end of the day, what I just explained is what the Rockefellers did than the Vanderbilts. And I hit it super high level. So how does this look for your family? Well, funny that I don't have a computer monitor anymore because I would have been able to show you, but now we're just going to do this a little differently here. So bear with me, folks, and I'll come back to your questions. Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris. So I've got something I wanted to show you, and I will be able to show it to you. I want to show you how Vivi's policy looks, and that's just her first policy. And then we'll get into actually showing you the numbers when I get somebody back here to figure out why I lost the monitor and why I can't open anything up. But anyway, let's just hit Unanimous's question here. It says, does death benefit go away if someone dies past a certain age? Some insurance policies, for example, the benefit expires at 80 years old. This is a great question. So let me go to another screen here. Now, let me just draw a line down the middle. And this is perfect because this is just what we talked about in last week's wealth webinar, where we dissected that money show and those two guys who were by term invested different guys. So there are different types of life insurance. And I'm going to keep it super simple. There's term and there's permanent. Okay, term and perm. Let's just call it that. Does anyone know the difference? Does anyone know the difference between term and perm? Who can tell me the difference? This is a trick question. It really is. I lost the top monitor and I can't open anything. Right, time. That's it. That's it. So it's in the name, Lynn has said. Okay, term is only for a period of time. It's for a term of time, right? Term of time. That's all you need to know. Now, if something is permanent, what does that mean? Well, it's permanent. It means it never ends. It means it's going to go for your entire life. You're never going to have to worry about outliving it. But what Unanimous said is there are some policies that end, they're permanent policies. So this is where the world's gotten different. So if we were just talking about term, you can do a 1 year all the way up to a 30-year term. And I don't think they have 40-year terms, but these are very valuable in life. These are very valuable. You will buy term insurance in your lifetime. I'm just telling you, I own it. You will buy term insurance for things that are a term of time. Now, who can tell me what would you want to protect for a term of time? And let me give you the first one. We'll get this thing started. How about a mortgage? You take out a mortgage on the house you live in. So you got this mortgage you took out. How long is the typical mortgage? It's 30 years, right? So if you were trying to protect to make sure that if you died too soon, that the house your family lives in is paid off when you're gone, what would you want? Well, you'd probably want a 30-year term, right? How about a car loan? Let's say you buy a really expensive car and you take out a loan because you haven't learned how to get all the money back for every car that you ever buy, drive, and own by what we teach. So you just bought a car the old-fashioned way, which is you went to the bank. The bank was gracious enough to give you a 9% car loan, and you're so happy because now you get a depreciating asset that you get to drive around every day, and people throw soda pops at it when you pass them on the throughway because hey, I guess if you're not first, you're last. So I guess now if you're not first or last, they throw soda at your car. Sorry, that happened yesterday. We were driving down the 33 and we passed somebody, they got mad and they chucked a bottle at our car. Crazy things, right? But if you got a car loan and it's a 5-year car loan, silly question, but how long of a term policy would you want to protect that loan? How about a 5-year term? That would make sense, right? So you can see what I'm saying, but does anyone else know what happens with a term policy? Well, let me give you statistics, actuarial certain statistics. The number is 2%, but it's actually less than 2%. Less than 2% of all term policies are paid out on. Why? Because the actuaries at the life insurance companies know for a fact that you're not going to die within 30 years or 20 years or 1 year. Actuarial. They can tell us all when we're going to die. So if they can tell us when we're going to die within a large group, do you think they can understand their risks? The only thing they can understand is if an asteroid hits the Earth. That was kind of whoops. We thought that one was going to miss. Or, if a tsunami comes and wipes out, an entire island. Well, I didn't see that one coming. There are unseens. And the pandemic hits and they think, oh my God, what's the exposure going to be here? So there are unforeseens, and that's what the insurance company is betting against. But if those unforeseens don't happen, then the facts are less than 2% of all policies are going to be paid out. But hey, it's a good thing that the term insurance is cheap, right? Term insurance isn't cheap at all. It's the most expensive life insurance you will ever buy because the chance of it ever paying out to your family is less than 2%. That makes that really expensive. So now let's come over to term. If you were to just buy a whole life policy, can anyone guess how long a whole life policy lasts? Your whole life, right? Yeah, it's pretty simple. But now they've got these things called universal life and IULs and VULs. So we're not even going to get too deep into the VULs, but ULs, a universal life, you could buy a universal life and you could pay what's called a target premium, okay? And that target premium might only make it till 80 years old. Your policy may expire at 80 years old. So if you live to 81 years old, all the money you paid into that policy is gone. Okay? You might buy an IUL and your agent in his ultimate glory says to you, oh, well, we're going to average about a 7% return on that index. And all of a sudden you don't get 7%. Matter of fact, I've never seen one that has actually gave returns like Illustrated. Not one. And I've seen hundreds of these stupid things. So now all of a sudden you don't get 7%, but they showed you that if you average 7%, this thing will go to 121 years old, just like a whole life. Whole life goes to 121, but let me tell you what happens at 121. This is really cool. Let's say James over here makes it to 122 years old, but he had a whole life policy. What do you think happened to the death benefit in the whole life when he reached 122? Actually, we'll just call it 121. James lives to 121 years old. And then one day after he lives, what do you think happens? Who can tell me? Yeah, James gets, how much does James get? James is still living. He didn't die. How much does James get? I love it. Drew was like, lots of money. Good one, right? James gets the death benefit. So if his death benefit's $10 million, the insurance company is writing James a check for $10 million. Pretty freaking cool, right? But if your policy lapses, keyword lapses, because this assumption, this 7% assumption doesn't happen. So therefore, the 121 was a fictitious number, and the agent or you forgot to look at the guaranteed column. So you all know whole life's guaranteed, and IULs have a guaranteed column. And if you look at that guaranteed column on almost every single IUL, well, let me ask you, who in here has an IUL? And when does your policy lapse on the guaranteed column? Anyone? Yeah, the death benefit? No, death benefit. Is it taxable? No, not if it endows. So, but hold on, let's get back to the IUL. So the IUL, if you assume something and your guaranteed column says that it's going to make it till 80 years old and you don't perform it 7%, when will that policy end? 70 years old. And what will happen to all the death benefit? It won't be the same as what happened with James's death benefit, will it? No, it's gone. Matter of fact, you can see on all the guaranteed columns on the IULs, the death or the cash value grows, then starts going down and down and down, and then the cash value goes to zero and the death benefit goes to zero. Same thing with VULs. It's even worse with VULs because VULs are 100% reliant on the market. Okay, at least an IUL has a floor. Okay, but you can still screw an IUL up, and here's how an IUL and a VUL will get screwed up. You start an IUL, a VUL, you put money into it, things get rough, you reduce your premiums. Hey, it happens. You lose your job, you get a little overexposed, or you just get a little crazy and you spend too much money, and all of a sudden you can't make those premium deposits like you initially planned to. So in a UL or IUL or VUL, you can reduce those because it is one of the big selling points is flexible premiums. Okay, flexible premiums. So you take advantage of those flexible premiums, but then all of a sudden your returns don't quite hit where they're supposed to. Your VUL, they show that to you at 8%, but that doesn't quite happen. You end up making 3. Guess what happens? Your policy will lapse, which means you will have no death benefit. So in Unanimous's example with 80 years old, that's why. The only thing that would save that, and it's usually too late at this point, would be the insurance company would say, to keep your policy in force, here's the new premium. So, Mr. Client, you started this awesome flexible premium IUL or VUL policy. Oh my gosh, it's the greatest thing. You make it till 80 years old. The insurance company sends you a letter at 80 years old saying, hey, Mr. Smith, it's been great knowing you. We've done your insurance for you for 30 years. Everything's been great, but unfortunately, the policy is close to lapsing. So if you don't want the policy to lapse, you have to pay $5,000 a month. I'm just making a number up. You have to pay $5,000 a month to keep it in force. Oh, I know, Mr. Smith. I know you were only funding it at $500 a month, but I'm sorry. It didn't quite do what we thought it was going to do. You know, those stock markets and those indexes, you know, you never can quite tell what those things are going to do. And, you know, Mr. Smith, it just so happens that, you know, we're in a recession. Yeah, those things happen too, and it just hasn't performed. So that's what's got to happen, Mr. Smith. You got to fund it at $5,000 a month to keep it alive. But if you can, it's no problem. The policy will just lapse and we win. How's that? You like that? Because I don't. But I'm just trying to explain there are only two types of life insurance, term and permanent. But when you talk about permanent, you better make sure that it's built permanent. You better make sure that it's built to last. Okay? You don't want to buy something that's going to maybe make it. Because at 80 years old, you're really starting to think about how your legacy is going to look. But you know, when you're 20 years old, how many 20-year-olds are really thinking about their legacy like this? Nope. But when you're 30 and 40, you're maybe starting to think about the legacy like this. When you're 80 years old, how many of you are thinking about the legacy? All of you. Guaranteed. So I just want to look up here. We got some questions that came in, and because Steven's not with me, I'm kind of talking because I want to teach you all and give you guys some value, but I also want to make sure I'm not missing any of your questions. So please do me a huge favor. If you have questions, don't put them in the chat. I have no one watching the chat. Maybe Shauna is. Put them over in the Q&A because I do want to hit them over there. Yeah, so Jimmy hit in there, just reiterated that if you endow, your policy endows, like James's, he made it to 121 in one day. That's called an endowment. That death benefit is paid to him tax-free, just like it would have been paid if he died. That's the rules. Okay, so Muhammad said, my IUL has already lost so much value. I don't know if it's worth keeping. $30,000 down the drain. Well, yeah, I'm sorry. I'm in the exact situation you're talking about. Now, folks, I didn't communicate with Muhammad before we got on this. I don't even know Muhammad. Or maybe we've met, maybe we haven't, but I don't think we have. So I'm just simply telling you, like, this is what's going on out there. And I do want to make note, I do want to remind all of you, we are still benefiting from the longest bull run in history. So if during a bull run, Muhammad is losing money in an IUL, what's going to happen to Muhammad's IUL and all the other IULs when we're in a bear market? Everybody knows the difference between bull and bear, right? Well, let me show you. Bear, bull. Any questions? Okay. Kind of like that old commercial, right? With the egg and, you know, your brain on crack. Any questions? Yeah, same idea. I don't know where that came from, but hey, sometimes I don't always have the best analogies. Is this video being recorded? I sure hope so. Yes, it is. We'll put this video up on my YouTube channel, which is at the Chris Naugle. So if I could just take and give a quick commercial break here real quick for anybody that wants to watch this video after, what you're going to do is you're just going to go to this page right here. It's called at the Chris Naugle. And there's usually a little subscribe button. You just click that subscribe button. There's a little bell. You smash the bell right there, notifications, so that when this recording from today goes live, you'll get notified. You're like, hey, guess what? That video where he's talking about crack and life insurance, yeah, that's live now. They actually won't say it like that, but you guys get the point.
So I made this little image here, if you can see it. Can you see this?
Yeah.
Okay. So we got a new show on Tuesday. It's going to start this coming Tuesday. We're going to call it Take Back Control Tuesday. And for all those new people today that are learning about IBC, Tuesday is going to be always about like the fundamentals of infinite banking, you know, the 101. Today is sort of sometimes morphs into like a 201 or whatever you call it, like more advanced. So we put Tuesdays in there, and I'll put it in the chat, but now we are coming at you live 4 days a week at 1 p.m. Eastern, Monday, Tuesday, Wednesday, and Thursday.
That is 6 live webinars a week. I mean, come on, folks. I'm not trying to toot my horn, but put your hands together for our team. Like, that's 6 live webinars, totally free, because we believe in helping you get to where you want to be. We want to help you solve your problem. Listen, like most other folks would probably charge you for 6 webinars. Maybe one's free, but it sells into the next one, and the next one sells into the next one. You all know how that works. We just do these for free because we want you to succeed. So let's see. All right, I want to get over here. So Shandi, I think I got that name right, over in the Q&A, said, should you change your IUL to a whole life? So that's a great question. So remember, we were talking about IULs and some of the problems. Mohammed kind of came in and gave some credibility to it because he's in the same situation where his IUL is underperforming what the hypothetical, how do you spell that? Hypothetical. I just want you to all understand there's a big difference between hypothetical and guaranteed. Guaranteed just flows. For me, it's just like guaranteed. And hypothetical is not an easy one. It's kind of like, you know, that duck, you know, yeah, anyway, you got that. So we got the IULs over here. So could I take my IUL and just convert it to a whole life? The simple answer is absolutely yes. You certainly could. You could do an exchange, a 1035 exchange. Okay, so I'm going to write that down. So the insurance companies would allow you to do, it's kind of like an in-kind exchange, and take your values from the IUL and move them over to the whole life. However, if it were just that simple, there probably wouldn't be many IULs anymore, and the insurance companies would lose lots of money on those IULs, ULs, and VULs. So they conveniently, in those IULs, put a fancy-dancy surrender fee. And it's pretty interesting. On that video we did last week, those two gentlemen who were buy term invest the difference guys, they said that whole life insurance policies have surrender fees. But I went through a contract. I went through literally the whole life contract, and I was just looking like, where is that surrender schedule? Like, you know, where does it say that there's surrender charges on a whole life? Now, you could surrender your whole life, so maybe that could be misconstrued. Maybe they just messed up their way they explained it surrender. But you see, let me explain how a surrender charge really works in an IUL, VUL, or UL. Every year, so year 1, 2, 3, 4, 5, 6, and I don't know, everyone's different. We go 7, we could go all the way down to 10. So these are years. So year 1, you might have $1,000 in cash value in the policy. And this is how they get you, folks. This is how they get you. You're looking, and Mohammed can back me up on this because he probably looks at this. They show you how much cash value you have. But then over here, they got this other column, which I've seen lots of spreadsheets where they don't even show you this. I'm surprised these people aren't in jail, or at least, you know, eliminated from the industry. There's a surrender value. So if you got $1,000 in year 1, anyone want to take a guess how much your surrender value actually is? Well, it's a lot less than $1,000. So let's just say your surrender value, I'm going to give them some credit and put $100. You got 1,000, you're earning interest in, you know, or the hypothetical returns on 1,000. But if you need to take the money, it's only 100. And then this just kind of keeps going. So year 2 is 2,000, and then 5,000, and then 15,000, and so on. This is great. And this is great that, you know, you got all this great cash value that you can use. But over here on the surrender value side, maybe you got 500 here, maybe you got 1,500 here, maybe you got 8,000 here. Isn't that a big difference? So back to, can you just take an IUL and turn it into a whole life? The answer is yes. You certainly can do a 1035 exchange, but who can tell me how much you can exchange over to the whole life? Anyone know? Which one of these columns do you think they'll let you move over to the whole life? If any of you are thinking the surrender value, you're absolutely correct. So let's just say Mohammed is only 3 years into his policy. He said he's down $30,000. So if he's down $30,000, how much is he going to be able to bring over? The lesser amount. So you're going to get screwed 1035ing an IUL unless you're later in the thing. And we've had lots of clients. We don't tell them ever to do it. We've had lots of clients say, you know what? I'm just going to peel the Band-Aid off. I'm just going to rip the Band-Aid off now because it's going to hurt a lot later, or a lot more later than it is today. So I'm just going to take the loss, call it a learning lesson, and move on. We've had a lot of people do that. But I'm not saying that's right for you. So just always consider, what are you losing by moving it to a whole life? Very important. Let's see. Doug Andrews. All right. I don't like using people's names, but yeah, he's pretty popular in the IUL space. So in the Q&A, Doug Andrews pitched me an IUL many years ago. He said that I am in control because I can always pick the year I am in the market and the year I can opt out of the guaranteed return. Does anyone ever truly make the right choice by year? You know, it's kind of one of those things. Can you time the markets? Does anyone know, can you time the markets? Absolutely not. Not even Ray Dalio can get timing the markets right. So, but Doug Andrews clearly says, hey, listen, you know, if there's going to be a year where the markets are going to go down, you just move the money to the guaranteed. And when the markets are going up, you just move the money back into the index. Is that about what he said, Jimmy? Yeah, because that's probably about right. But how many of you really think you would know when to do that? Oh, hey, I got a hunch. I got a gut feeling. I'm just going to move it into the guaranteed. And then all of a sudden the market tanks. You think you're going to get that right? Or, you know, hey, I got a gut feeling. I know we've been in this bear market, but I think tomorrow the markets are going to go up. I'm going to flip it back to the index. I don't think so. It isn't going to happen. And then you would probably rely on, and who knows what Doug would say, but you'd probably rely on Doug to maybe call you and say, hey, you know, hey, Jimmy, you should probably move that cash value into the guaranteed now. Yeah, I'm watching the markets. I'm doing some trending, and I think you should move. You think Doug Andrews is going to call you and say that? Listen, like, I'll tell you something. As a financial advisor, when I didn't have nearly the amount of clients I did now, or I do now. I had maybe a couple hundred clients. I would do my very best when the markets were going down to try to reach out to my top clients, because I couldn't get to them all. I'm sure Doug Andrews has thousands of clients like we do. But the beauty between me, or the beauty of what I do and what Jimmy, or what, not Jimmy, what Doug Andrews does, is I don't need to call my clients and tell them when to move in and out of things, because the product that we use for the infinite banking concept is a whole life, a specially designed whole life, and it is guaranteed. So I don't have to call clients and tell them that. Where Doug Andrews, I guess, hey, Jimmy, maybe he does call all of his clients and say, hey guys, we should move into that guaranteed account. Anyway, great stuff. Sorry, I sometimes just get a little silly on these things, but let's get back to the original reason. Now that I've got my team, they came out and they fixed me up and my monitor's working. Let's come back to what we were originally talking about. Everybody understood what I did here, right? Yes, I know there's a lot of pieces that I left out, like, oh, Chris, what kind of trust did they have? Was it revocable, irrevocable? Was it one of those spendthrift trusts? Like, whoa, hold on. We can just understand that what a trust does is gives you a set of rules. So let's go back to that set of rules. So remember, the first generation of the Rockefellers passed away. They all understood the rules, but the trust had trustees which were not family members or that were appointed by the Rockefellers to see the best interest of the trust when they were gone. And the trust also had some rules of engagement. Okay, we'll just call them rules for now. And those rules were that when these kids got to, you know, the point where they were running the businesses that their parents were, okay, they took over the operations, they took over the parents' companies, they're now running them. They now know the rules that is, if you want money from the family trust, here's how you get it. You submit a loan request. The loan request will be reviewed. We will come back and ask for additional information. We might want to tour your company. We might want to see your books. We might want to see how you're doing. And once we assume all that, what we're going to do is we're going to loan you money because we have our own family banking system. But you cannot be denied if you come with a good plan. And if your business fails and you can't pay the bank, well, then the family trust will have to go in and probably liquidate everything and make it whole. But does it really matter? So you see, when you don't pay a traditional bank, they strip you of everything. They kill your credit. They pretty much destroy you and your ability to do anything for pretty much the next 10 years. True or true? The Rockefeller family banking system, the trust, if one of these kids does a business and fails and can't pay the trust, do you think they're going to crush that Rockefeller child's credit? Do you think they're going to take everything from that Rockefeller child? No. They're going to say, hey, I hope you learned something. I know it sucks, but you'll get back on the horse and you'll be good. And when you do, just try to pay your debts back to the family trust because, hey, Mr. or whatever, we'll call the kid Robbie, it's okay, but this is a learning lesson. And eventually you're going to get it right. And we're going to help you get it right because it benefits us for you to get it right. And we know, Robbie, that someday you're going to die. It's a funny thing that happens. Yeah, someday, I know you're only 20, but someday, yes, you're going to have to die, just like others in our family have died. And when you die, guess what's going to happen? Your policy is going to pay a death benefit. And that death benefit is going to be paid back to the family banking system. And it's going to be sufficient to make sure that the family banking system is repaid for that loan that you weren't able to pay. So little Robbie, I hope you learned. It kind of sucks, but it's cool. Isn't that cool? Yeah. Well, have you ever noticed how some banks with some loans, they will require you, force you to get life insurance and name the bank as beneficiary? Why? Do you think it has anything to do with this? But also, let's just say you set rules with your family trust and you let all the kids know, generation after generation after generation, that all their cars that they want to buy, all their houses that they want to buy, all their businesses that they want to fund, everything in their life that they would normally go to a bank, they no longer go to a bank. That's written in the family code. Okay? And anything that that family member wants to buy, they have to take the loan first from the family banking system. Now, if the family banking system won't give them the loan, like that drug example, well, then they got to go out and figure it out on their own. But the family banking system funds everything that the family does. Therefore, the family banking system is in full control of their money, and every single payment for everything every family member ever buys goes back to the family banking system. And there's no chance ever of the family banking system going defunct, because we all will die. And when we die, the death benefit is always paid back to the trust. And the trust and the life insurance policy, this is perfect, is a permanent whole life insurance policy, which can never end. And why would it ever end if the trust is paying for it? It wouldn't. Do you think the trust is ever going to, whoops, we forgot to make those premium deposits and have the policy lapse? Heck no. They're always going to make sure. Priority number one in the rules is make sure premium payments are made so policies don't lapse. And then rule number two, make sure family uses family banking as a first option for all loans for everything they're going to buy. And rule number three, make sure any loan that is issued to family members is loaned out at this interest rate and maybe 1 point above prime or whatever. They set it however they are. And make sure that any loan that is issued from the family banking system that is not paid, that family member is going to have to pay that someday. And if they don't, the death benefit will pay that back. Where would be the problems with future generations? Well, I can tell you, you'd never have future generations squandering all the family's wealth away like the Vanderbilts, because they can't. They got a set of rules. You're never going to have the family not get bigger and bigger and wealthier, because it's almost impossible, because compounding interest. So all this cash value now, which is $10 million, all that cash value is earning compound interest at a rate of, I'm just using today's rate of 5.5%. And every single time loans are taken out, they're always taken out at a rate higher than what the cost of funds are. So they're also making a spread. So not only are they making compounding interest, they're also making a spread. They're making money twice on every single dollar, which is 10 million of them. And then the next generation dies. So then all of a sudden this generation passes away. And now how much you got? I don't know. Let's just say now it's 20 million. And then 30 million and 40 and 50 and 60. And all of a sudden, now you got yourself a real cool system going for future generations. Now, me and all of you, at that point, we're gone. But we set something up today that will live way longer than us, that will outlive us into perpetuity. I mean, literally, what could stop the Rockefeller family banking system? An act of God. That is about it. An act of God. Because no family member can screw this up. One family member said, we're not going to let our hard work, our family fortune, be squandered away by one bad apple. And in most families, is there not usually a bad apple somewhere down the line? Yeah, usually there's a bad apple. So folks, listen, I'm going to get to the questions now. I'm just laying this out. There's a lot more to this. You're going to have to work with your attorneys. You're going to have to find good estate planning attorneys. You're going to have to find really good CPAs that understand how to do this. But that's all just part of the game, and that's part of the learning experience. I knew nothing about any of this. And I have learned and applied and failed and applied. And I'm still learning every single day. Matter of fact, I'm still making mistakes in my family banking system. That's right. That's why I've got Brandon, who now is sitting over here. James has exited, and now Brandon is sitting over here. And Brandon is helping me run my family banking system so that when I get too busy, I'm not making stupid mistakes. You will be no different. It might just be you today starting this off. This might be ground floor. This might be your first step, but it won't be your last step. And that's the only thing that matters. If you set it up correctly from the start, you really can't screw it up. You'll make mistakes, but you really can't screw it up. And you definitely can't screw it up when you've got a guaranteed engine behind it all, which is that stupid whole life policy that we keep talking about. And the other thing too that I really didn't get into here, but I kind of want to just draw it over here. Remember the family trust, let's just put the trust here, owns all the policies, right? So I'm just drawing it different. Everybody can see this, right? All these little boxes or circles or whatever that is I'm drawing, these are all the policies. The trust owns them. So the owner, so we'll just write owner is trust, okay? Policies are whole life. That's not how you build wealth. But what else did we explain happened? Let's get a fresh look at this. Now that you understand all that, I want you to all be able to see what I'm going to do here. There's nothing difficult about what I just did. So now over here, this is the policy, and there's going to be lots of these because the family has got lots of policies. All of these make up one giant pool of cash value money and one giant pool of death benefit money. And then over here are all the things that you're going to need in life. You're going to need cars. You're going to need, I don't know, equipment. You're going to probably buy boats or things like that, or houses. I mean, all the big things you're going to buy, and maybe furnishings and business opportunities and private loans and real estate, if I didn't already mention that. So all these over here on this line, let's just call all of these opportunities. Now, many of you right now today don't view each one of those things that I just wrote as an opportunity. How many of you think of your car as an opportunity? How many of you think of your house as an opportunity, or your equipment, your boat as an opportunity? How many of you think of your, I don't know what I was writing here. I wrote fun. I don't know what that was, but how many of you think of your business as an opportunity? Private loan for sure, real estate probably, but you know, some of you don't think of those as opportunities, but when you are the bank, everything's an opportunity. So we take the money from that family banking system, and that funds every one of these opportunities, but every one of these opportunities comes along with a payment. Everything's got a payment, right? Your business, your car, your boat, everything has a payment. So every one of these are payments. Payments come along with business, and the payments now all go back over here. Whoops. All go back over here. So every payment for everything your family today and well into the future all come back over here. And the entire time this is happening, your family banking system is making a spread and compound interest. So do you know what this is that I just drew? This is what's called the infinite banking concept. And the infinite banking concept has nothing to do with a product. It is a process of moving your money and controlling your money. That is it. Just a process. So let's hit some of these questions. So we got Jimmy said, and the trust gets to reduce any trust income by all premiums paid to the policies. Yeah, we didn't get into that. We didn't get into the fact that if your whole life policies are owned, just wrap it around by a trust, if done properly in the right structured trust, you could get write-off for the trust in terms of the premium. So your premiums can be a tax write-off. So that's what he's saying. And that is coming from a CPA. As individuals, we do not get to reduce our taxable income by the amount of premiums, but a trust does. Good observation. All right, what's next? Drew said, does the structure need to be put into a complex trust, or are there other trust structures that work? There are definitely other trust structures that work. So we're not going to get deep into the type of trust or the structures of the trust. I'm just calling it just a trust. You've got to figure the rest out yourself. And then Greg said, can I contact the money multiplier team to start setting up a trust, or do you provide contact info for whoever does that? Yeah, we would provide the contact info. So here, I'm just going to give you.
They can email me.
Yeah, that's exactly. See, Stephen, I didn't even know he was there. He's sitting out by the water, or he's just got that AI background.
It's good action.
Look at that. See, isn't that incredible? Look at that. Now he's sitting in a lawn chair. It looks like he's actually on a beach, and that's just artificial intelligence. Isn't that freaking wild? And look, it even looks like the wind is blowing his shirt. Man, the technology these days is wild. Stephen, dude, get outside. Go enjoy the weather in Florida. Stop sitting in your office using that AI shit. Get out there and enjoy it. All right, so let's see. I just want to make sure we got this. A couple other ones. We got Chris said, and that's why each succeeding generation of Rockefellers gets wealthier than the previous one. Exactly. I mean, I sort of just drew it out. I mean, They're doing exactly what I've been telling you to do for years, what my team's been telling you to do, what Brent Kessler's been telling you to do, and what R. Nelson Nash was telling you to do. And what we're all telling you to do is take back control of your money by being the bank. We are not telling you, no one that I just mentioned is telling you, go out and buy a whole life policy, because that's the secret sauce. You just buy the stupid whole life and you're rich. Absolutely not. The whole life will not make you rich. The whole life by itself actually could make you poorer. Because Dave Ramsey's right? Whole life is a terrible investment. That's right, Dave. Whole life is not an investment, because an investment involves risk. A whole life is guaranteed, but the whole life by itself does nothing other than guarantee that someday when you die, there's a death benefit going to be paid out, because it's permanent for your whole life. And it gives you a little extra compounding interest and, maybe some tax advantages. That's it. But take that whole life, design and engineer it for high early cash value, add that to this whole awesome system, and what do you got? Wealth. Now, Henry Ford came up with the idea for the Model T. But would the Model T have ever made Ford what it is today if he didn't figure out the assembly line? You see, it wasn't the Model T that made Henry Ford who he was and made Ford Motor Company what it was. It was the assembly line, the process that he invented, that he used, and that he pioneered that made Ford what it is. The assembly line process. The whole life, the product is never going to do anything. You need the process if you want to get wealthy. I just showed you one little advanced technique of how to use that process inside of your family mechanism, whatever your family mechanism looks like. Some are small, some are large. Apply this in your family. Teach your kids this. I say this all the time, and I'm going to wrap with this. I tell people all the time, and I said it in my TEDx talk. If you haven't watched, if you're a dad, okay, I'm just going to pick on all the dads. Moms, I'm going to get to you in a second. But if you're a dad, watch my TEDx talk. It's called Rethink Money, a letter to my daughter. Just watch that. We have to start teaching our kids how to be in control of their money. We have to start teaching our kids how money works, and we have to start teaching our kids how to be the bank. Now, moms, you can watch my Rethink Money, and you'll probably equally get impacted by it. But again, we all have to do a much better job of teaching our children. And in that video, that Rethink Money, I tell everybody, I said, the funny thing is, my daughter's going to grow up. She's going to have friends and peers and other people she's surrounded with, including teachers. And she's going to watch the way they use money. She's going to watch the way they buy things. And she's going to have no idea why they do what they do. And then she's going to try to help them inherently, because that's just her nature. Vivi's going to try to tell them, oh my God, why would you do that? Why would you take a loan from the bank and pay them all those monthly payments and your car goes down in value when you could have been the bank and you would have got all the money back for that car? Like, why would you do it the other way? And she's going to have a really difficult time, because no one's going to understand what she's talking about, but she'll understand it. So it is our job as parents to make sure that our children understand this, because if we don't teach our kids, just understand this, no one else is going to. Matter of fact, everybody else is going to teach your kids how to give up control of their money. They're going to teach your kids how to make sure your kids are not successful and don't understand money. And I'm not saying that's inherent. I'm not saying that they're trying to. They're just going to teach your kids what they've learned. And what they've learned, most folks, is one giant lie. So let me just wrap by showing you one final thing now that I got my screen. And I just want to kind of I've shown this before. I'm going to show it again. So what this is Vivi Lucky Jeans, we call this. This is my daughter's very first whole life policy. She was 6 months old. Man, she was getting old, 6 months old. And I started this dumb whole life policy for her, and I put $5,000 a year into this thing. Now, again, remember I said, your kids, your family's not going to get wealthy by buying a product. It's the process that's going to make them wealthy. So let me just go through and explain the process. So I put money into this policy, and I know a couple of things, not all things, but I know a couple of things. I know eventually someday Vivi's going to have to decide if she wants to go to college. And if she wants to go to college, she's going to need some money. Now, where do you think Vivi's going to go to fund her college? Is she going to go to the government and take out one of those student loans? Is she going to go to the bank and take out one of those student loans? No, she's going to go to her banking system. And she's going to take whatever it takes to go to college. But I just showed 20 grand a year, probably a little light. Okay, but 80 grand. There we go. Her college is funded. She's probably going to get married. And she'll probably won't do what her parents did and, elope. She'll probably actually have one of those weddings that cost a whole bunch of money, because why not? Well, that costs money. And where's she going to get the money to pay for her wedding? Yep, her banking system. I know some of you were thinking, mommy and daddy, oh no, Vivi's going to take a loan from the family banking system and pay for the wedding. Now, mommy and daddy might help pay for that loan. I'm just saying we might support or, supplement that loan, but she's going to know that that money came from her banking system. And eventually she's going to need a house. You think mommy and dad are going to buy Vivi her first house? Oh, no, no, no. She's going to do exactly what daddy and mommy had to do, buy our own house. And she's going to take a loan from the banking system, which means either one of two things. Here I just show a house down payment because it's more applicable to most people, but she could just fund the whole house. But if she just took a down payment for a house, there it is. Okay. And eventually she's going to have kids, right? And when she has kids, they're going to need to go to college. So she's going to fund their college from her policy, her banking system. And then someday Vivi's probably going to want to retire, right? Well, she's going to want to supplement her retirement with tax-free income. So when she does that, she's going to take $90,000 per year tax-free. And then I have 90 years old because, hey, at some point we all got to understand that like mortality is going to catch up. So let's just call it 90. So at that point in time, at 90 years old, how much has Vivi and mommy and daddy paid into that policy, that stupid whole life? $398,000. How much has she taken out to fund her lifestyle, her kids' lifestyle, houses, college, weddings, retirement? She's taken out $2.73 million. How much money was in there earning interest and dividends the entire time? And how much was the total cash value? $5.578858. So $5.5 million earning interest and dividends the entire time. Okay. And then how much was left that she didn't use during her life? Well, 2.9 million. And what was her return over her life on that dumb whole life? 738%. That's just one, folks. That's one policy for $5,000. What happens when Vivi has 10 of these, 20 of these? What happens when Vivi's policies are combined with daddy's policies, which are combined with mommy's policies, which eventually are combined with Vivi's kids' policies? Now, what does the family banking system look like? If this is just one $5,000 policy used for banking so that she never has to use a traditional bank and give wealth away to someone else's bank, she contains and keeps all the wealth in her family. Are you picking up what I'm putting down? Because I don't need to start doing the math. I think you're all smart enough to understand what that starts to look like. Well, listen, I was right where many of you were. I was right where many of you were. When I first got into doing this many moons ago, I was broke as a joke. I was a real estate investor, a financial advisor. I had just gone through 2008, the Great Recession, almost went bankrupt. I was on the floor. I had barely enough money to make ends meet every month. Every month I knew I had to make that mortgage payment. And eventually it got so bad, I had to ask Larissa to help me make the mortgage payment. And then eventually it got so bad, I had to move in Pete and Jessica into my house. And it wasn't just Pete and Jessica, it was Pete, Jessica, and Jessica moved into my house. And I had a pretty small house, I think that house was probably 1,500 to 1,700 square feet. That's right. I had all those people living in our house with me and Larissa, paying me rent because I had to make ends meet. Yeah, folks, that's where I started. Now, I'm not going to tell you where I'm at now, but I think all of you can kind of look around. Maybe you've seen the couple cars I have. Maybe you've seen the house I live in. Maybe you've seen the office. I was broke as a joke when I started. So I don't care where you're at. Some of you are like, well, I'm not broke as a joke. I'm wealthy. Great. Well, get wealthier. But no matter where you're at financially, you're in the exact right place to get started. So hopefully this has helped, folks. Hopefully I kind of gave you an idea of some different things you can do for your family so you can start actually building something that will outlive you, something that will be remembered generations and generations into the future. And let me go one step further. Just imagine this. You set this all up, and in that trust, you put one provision. And that provision says that every single child that is ever born into your family's bloodline, every year on their birthday, they're going to get a check from Grandpa Chris. Every single year on their birthday, no matter how many generations down the line that goes. How many of you think that Grandpa Chris will be remembered well into the future if a check shows up every single birthday for every single grandchild, no matter how deep it goes? And how is it all funded? Your family banking system. So, all right, folks, that's all I got for you. Shauna, is there anything else we want to put up here in wrapping this up? I know I wasn't able to put the link, but hey, listen, I'd be remiss not to say, if any of you are interested in learning more about this, you want to get on the phone with one of my team members, our money mentors, to start talking about how this could work for you. Stephen just put the link up right there. That's how you book a call with us. See that little link? Mentors.beyourownbanker.com. Every week we do 6 webinars. Please join us for other ones. They're all a little bit different. Okay, this is just kind of whatever I feel like doing. This is the one I do. And then on Mondays, you can do the Private Money Club webinars. On Tuesdays, you can learn about the baseline infinite banking. It's the 90-minute video, the one that I first watched many moons ago that I still deliver today. And if any of you are brand new, that's where you start. And then we got Quick Start for all of you thinking about being the bank and you want to get into private lending. That's every single Thursday. And nonetheless, I'll see a bunch of you this afternoon for Ask Me Anything, which starts at 4:30, and we'll see you then. And now, just so you know, that's Eastern. With that being said, folks, we'll see you next time. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.